There we go. So I'm Michael Manatskayan. I'm a self-made real estate investor. I currently own 42 rentals worth over $10 million. I started my real estate investing journey in 2018 when I started consuming as much information as I could on BiggerPockets, listening to the podcast, reading the forums. And it was the spark that I needed to start learning about real estate investing, what it means to be a real estate investor, how to underwrite deals, how to find deals in a local market. And then in 2020, I actually purchased my first property. My wife and I house hacked a 2-unit property while I was stationed up in Fairbanks, Alaska, with the Army. We lived in 1 unit, rented out the other, and we actually did the same thing in 2021. We did that with a 4-unit property. And at that time, I started learning about wholesaling and started wholesaling out of state. Since I lived in Alaska, I didn't really want to do too much more in Alaska. So I started wholesaling out of state. But that's also the time I started learning about additional ways of finding deals off market, and then being a little creative with seller financing. So I started targeting tired landlords with multifamily properties in my local market to purchase their properties. And then I started wholesaling out of state, primarily in Huntsville, Alabama, with a partner, and continued wholesaling. And at 2021, I ended up purchasing we had the duplex of 4-unit, and then we ended up purchasing 20 rental cabins using something called the Morby method, which is just a form of creative financing. It's kind of seller financing combined with a bank loan. And in 2022, I got out of the Army, moved back down to San Diego, house hacked another 3-unit with my wife. And I got all into creative financing, and we haven't stopped purchasing properties creatively throughout all of 2023. We've continued to purchase properties. So I used to be a wholesaler. I still wholesale a few deals. We can go into what wholesaling is later, depending on your background. But I've done over 100 transactions, and I've been part of plenty more in a variety of capacities, not just wholesaling, but JVing, consulting, helping dispo. Kind of been part of every single part of the deal process. But I'm primarily now a buy and hold investor. I buy real estate and try to retain it for as long as possible. So you got to make sure you're buying your deals right. I achieved financial independence at 27 years old with 26 rentals while I was still active duty in the Army. I never made over 6 figures until, last year, but I achieved financial independence before then through real estate investing, both through house hacking and off-market deal finding, creative financing. And, but I still work my W-2 because it's something that brings me a lot of joy and passion. I work in the field of environmental health, and I'm able to protect my local San Diego community and really take care of the environment, our community, and the people that live there. So it's something I'm really passionate about in addition to real estate investing. So by trade, I'm a chemical engineer. It's what I studied at UC San Diego. I've always been a numbers guy, problem solver, and I love spreadsheets. My wife said the only reason why I got into real estate is because I just wanted a new spreadsheet to make. And we have the #1 free and paid creative finance calculators that are out there that really allow you to underwrite the majority of creative finance deals. And I'm a member, a leader, and a mastermind alumni within the Sub2 community. Some people call me the creative engineer. I like that, and that one stuck with me. I'm just really a numbers guy, and I don't just underwrite deals to see, okay, does this deal make sense based on the terms that are provided by the seller or wholesaler, or the deals that I structure. It's what can we do to change the terms of the deal so that it actually becomes a deal, something that is worth buying, or just deciding quickly this just isn't going to fit our buy box. Both the seller and I, or the wholesaler and I, just have different goals. What I'm looking for as a buyer, and what they're looking to sell their property for. And then I'm really passionate about helping others engineer their path to financial independence. It's a real big goal of mine. I'm not one of those necessarily that's hyper focused on generational wealth and all these crazy financial aspirations. More than financial independence has always been my goal. So I have the time and financial freedom to pursue whatever I want, whenever I want. So that includes, if I still want to continue working my job, that includes being able to travel and work on my own schedule, work remotely primarily, and just do the things that I want without having to worry about finances being a limiting factor. And that's where I really try to help people at least get to that point as much as possible. And that's kind of why we're hosting the Zoom today, to help you be a better underwriter. And if you're a buy and hold investor, have a better mindset of what are the deals you should be buying that fit your buy box, that hit the goals that you have. Is it helping you hit the goals that you have? So let's hear it from the man himself real fast.
I had a guidance from a friend of mine in the community. I don't want to butcher his last name, but his name is Michael Manatsakani.
Yeah, he's genius. He's mastermind student as well. Really great guy.
The creative engineer.
I just want to share that, don't mean to toot my own horn, but thanks, Pace. Okay, so an outline for today, right? We're going to talk about what are the different financial benefits of buying real estate. This is not just focused on underwriting. We're going to start with some theory at the beginning to really help you understand what are the deals that make sense for you to buy. Why are you buying real estate in the first place? Does it really benefit what you're looking for as an outcome? And then we'll get into underwriting all types of deals, including a variety of creative financing deals. And then as time allows, we will do a Q&A on underwriting, creative finance, whatever you have. What we're not going to hyper focus on, since this is recorded and potentially will be shared, we cannot list specific addresses, go on YouTube or go on like Rentometer to look at specific rental estimations and get comps for properties, because then we're showing addresses and that could be an issue. It usually flags your videos. So what we're going to do is, oh yeah, Esteban, you got a question? Oh, you can't.
Can you hear me?
Yeah, we can.
I was going to say real quick, if you let me reclaim host, I can broadcast this to Facebook and then just give you the access for those who didn't make it. Do you want me to do that?
Sure, let's do that.
Okay, let me reclaim host real quick. Let me share this over to going live on Facebook. All right, setting up.
Okay, let me know when we are. Sorry, y'all, I do apologize for the technical difficulties. It will get better over time as we do more of these. Are we good?
Yep, you're host now.
Okay, perfect. Thanks, Kim. All right, let's just continue going. Okay, and then as time allows, we'll go over any Q&A in regards to underwriting creative finance. Like I mentioned, one thing we can't do is necessarily go into addresses and things like that, because we don't want to get this video flagged so that people can continue watching it. So let's get into it. So this is the caution that I always put out. I've been putting out for years, even when interest rates were 2%, 3%, 4%, that most properties for sale are best bought by residential people who are going to live in it, like a homestead buyer, someone who wants to live in that property. Most properties are not good real estate investments, especially a lot of single family homes. It is your job, right, as the person buying or underwriting the deal to understand, is this a good investment or not? And fortunately, it's fairly predictable. You can pretty easily determine the financial outcome of owning your property from a best and worst case scenario, right, within reason. If you are good at underwriting investments and understanding what you should be looking for and what you should avoid when you're trying to make these big purchases. So at a high level, let's look at some of the common investing strategies, right? The thing we're going to focus on today is buy and hold investing. It's pretty straightforward, right? You're purchasing a property, you're putting money in to acquire that property, and you're expecting to make more money each month than you are spending on that property. And that's your cash flow. We'll break that down further. Typically, this is when you have long-term tenants. Most of you are familiar with that. You've rented out an apartment. That's what you're doing. You're a long-term tenant. There are strategies to drive your income and offer different types of rentals, typically furnished rentals, midterm rentals for those that are usually staying between 30 days to 6 months, 9 months, short-term rentals. You're very familiar with that, Airbnb, and it's usually your average stay is under 7 days. Today, we're primarily going to focus on buy and hold investing for long-term rentals. So at least you get the foundation for how to underwrite those types of deals. There is house hacking, something I highly advocate for, where you are purchasing a property, whether it's a multi-unit property, 2 to 4 units, or a large enough home with extra rooms. You're living in either a room or one of the units and renting out the rest. That's a very common buy and hold strategy that I think everyone should leverage if you have the credit and income to do so. And then another one that used to work a lot better when interest rates were low is the BRRRR strategy, where you are buying a property. It's basically fix and flipping it. Instead of selling it, you're refinancing it and keeping the property for yourself. You're pulling the money out that you put into the deal, paying off everyone you had to, and you are reusing that capital to do more and more deals. The big component there is you need to refinance. So when interest rates are much higher, it's a lot harder to make sure deals still pencil out. There is fix and flipping, which most people are, aware of. You're buying a property, you're renovating it, and then you're selling it for a higher amount. That's the main focus. You are just buying a property at a discount, improving it, and then selling it for a higher amount, and that's your profit. There is the live and flip, which is kind of like house hacking in the sense that you are living in the property and renovating it as you're there. And if you own or occupy that property for up to 2 years, you get a bunch of capital gains, tax exemptions. We're not going to get too much into that. And then wholesaling, where you're basically putting a property under contract at a discount and then selling that contract to someone else. Basically, you're putting together a deal and you're selling that deal to someone who's going to be the end buyer of that property. And like I said, what we're primarily going to focus on today is long-term rentals, buy and hold investing. So what are the different ways you can make money as a buy and hold investor in real estate? So a common one people know about, and this is especially if you have a primary residence, someplace that you're living in, is appreciation. So over time, historically and consistently, there's some irregularities, right? There's some black swan events that occur, but properties increase in value over time. As long as there's not huge shifts in the economy of a local market, properties will increase in value over time. And that is appreciation. The property is worth $100,000 when you bought it, worth $300,000 when you sell it 20 years later or whatever. That is a common one. That one, on average, people are assigning 3% appreciation year over year for a property. And that is appreciation. That's one of the benefits. It's not necessarily super tangible. It adds to your net worth if you account for it. And you can, over time, be able to pull some of that capital out, or when you sell it, you can get some benefits from it. But it's not the main one people are looking at when they're buying properties, unless they're in very specific markets. Like myself in San Diego, I do account for appreciation over the long term because it's a phenomenal market. Next is debt pay down. This, once again, is focused more on the equity, how much equity you have in the property, which is tied to your net worth. This one is an amazing concept because every month that you have someone living in there, they are paying down your mortgage on your loan on that property, the principal portion of it, and that is directly benefiting your net worth. They're buying you that property essentially, and as long as the cash flow is there, you're not putting any additional money outside of when you purchase the property to get the benefits of debt pay down. This one's an amazing concept, and this is something I definitely do account for. There are tax benefits of real estate, lots of tax-related deductions. The main one being depreciation, including bonus depreciation, where basically depreciation is the property is worth a certain price, the sale price or the purchase price you bought it for, and you can depreciate that asset or take tax benefits on it. Basically, take that property's value, divide it by 27.5, and you get tax benefits on that. You get to write that off your taxes. Typically, for most people, you get to only write off your passive investments, passive taxes. I mean, talk to your CPA. I'm not financial advisor or CPA. I'm not here to give you investing advice. I'm just here to share with you what I do know and what hopefully helps you just be the spark for buying your first deal, your next deal, whatever it is, or just underwriting better deals as a wholesaler, buy and hold investor, lender, whatever. But depreciation is something that's really important for me and my family. My wife is considered a real estate professional, and because of that, we can take the losses from real estate and offset our active income from other sources. So tax benefits are a huge benefit, especially for me, and that's a huge benefit for a lot of people that are looking to offset some of their income. And the most common one people are familiar with is cash flow. And simply, cash flow is the profit that is left over from your income after paying off your loan, your expenses, and setting aside reserves. Right? So the main thing people are focused on when you're underwriting is cash flow. And we're going to talk about that. But just remember, there are a variety of benefits to buying and holding real estate that you don't really get. When you're fix and flipping, you're getting a profit up front. When you're wholesaling, you're getting a profit up front. But when you're buying and holding real estate, there's a variety of benefits to it. And the main one that we underwrite for is cash flow. That's what we're going to spend today focusing on as well. So how do you determine a good deal, right? We're talking about cash flow, right? There's two key metrics for analyzing buy and hold rental properties. So there's cash flow, which is your income. It's your profit for a real estate property. So it's your income minus your fixed expenses, minus the reserves that you're setting aside each month for things that are going to come up. We'll further break that down. And then you need to understand that cash flow relative to the amount of money you had to invest to generate that cash flow. And that is your cash on cash return. So it's your annual cash flow, 12 times your cash flow, your monthly cash flow, divided by the money you invested to acquire that property and get it into rent-ready condition. So once again, breaking down cash flow. Income is pretty straightforward, right? It's your rent, any fees, let's say late fees or pet fees or laundry services, whatever. Your fixed expenses are typically your mortgage and loan, your taxes and your insurance. Your mortgage typically comprises of your loan, your principal and interest, your taxes and insurance, your PITI, but it's really important to separate those out because your loan is going to be fixed over time, whereas your taxes and insurance are typically increasing over time. Any utilities that you're covering, any property management costs, even if you're self-managing, it's really important to account for property management. And then your reserves, which are money you set aside every single month for if and when things occur. For example, vacancy is your property is vacant, no one is living in it at that time. So you set aside 8% a month, which is essentially translates to 1 month of vacancy a year. You have your maintenance at 5% of your total rent. So these percentages are of your total rent. You're saving aside these reserves. So if it's $1,000 in rent, you'd save $80 for vacancy, $50 for maintenance, and $50 for CapEx. Where maintenance is if you have to get like a plumber sent out because there's a clog, or you have to do some painting and things like that. And capital expenditures, similar to maintenance, is for your bigger ticket items that are degrading over time. So your roof is going to have to get replaced. Your appliances will have to get replaced. Your hot water heater, things like that will have to get replaced over time. And you need to make sure you have the reserves accounted for. Otherwise, you're going to be hit with unexpected expenses that you were never saving for. And the what you thought might have been a good deal ends up not being one because you're continue investing more of your money into it. So income, pretty straightforward, right? It's just all the different income that the property generates, whether it's a single unit or multi-unit. This example shows a four-unit property that has all 2x1s, but they each have slightly different rents, and it just shows your total income on that. I, as a starting place, leverage Rentometer and Bigger Pockets, their rental estimator, as a resource to get your rental income. That's like at the surface level, gives you a rough idea. Once again, I cannot unfortunately do that during this session because I cannot put addresses in today. There's your fixed expenses. As I mentioned, there's your mortgage payment or the principal and interest payment on your loan. Your other expenses include your property taxes, your insurance, any mortgage insurance. And this is if you are buying a property, typically owner occupied, and you're putting less than 20% down payment, there's going to be mortgage insurance or PMI, property mortgage insurance, accounted for there. If you're covering any utilities, you want to account for all that, and you want to make sure to account for your management. There are your variable expenses, which is what you will be saving every single month. You don't expend these every single month, but you will be saving for them if and when these occur. So once again, it's the vacancy at 8%, maintenance and CapEx at 5% each. And these are of your total rent. And just simply your cash flow example here. And we're going to get really nitty gritty into this stuff. I'm just giving a high level overview for those that, may not have this foundational information. So you have your rental income minus your mortgage or the principal and interest of your mortgage. So the loan, your expenses, your reserves, and that leaves you just income minus all these expenses and reserves leaves you with $740 a month of cash flow on this property. That sounds great. So you invest money up front and you get $740 a month back, and your property is self-sufficient and has reserves accounted for when things inevitably go wrong. However, cash flow can only take you so far. So $740 return can be great. And even in this example, if you cash flow $100 a month, that could be great, or that could be absolutely terrible. It matters how much money you had to invest initially to get that $100 a month return. So if you have $100 a month that translates to $1,200 a year in cash flow, annual cash flow. It's a very big difference if you had to invest $12,000 to get that $1,200 a year in cash flow versus $120,000, right? Your cash on cash return, your annual cash flow divided by your investment amount can be 10% or 1%. It just really, or is that 0.1%? I don't know. It could be a great deal or a terrible deal, depending on how much money you have to invest to get that. So let's quickly touch on cash return. This is the most important. This plus return on investment are the most important metrics for those that are investing as buy and hold investors. And whether you're wholesaling or lending, you really want to understand this piece of it, because if you don't understand what your buyers are looking for, it's really hard, whether you're the one buying or trying to wholesale someone a deal, it's hard to understand why people are not buying your deals. This is why. And I'm going to live underwrite a few deals that were recently posted in a variety of communities that people don't understand why no one's buying their deals. They're just not actual deals. And we'll go through that together. Once again, cash on cash return is your annual cash flow divided by your initial money invested. Your annual cash flow is 12 times your monthly cash flow, and your initial money invested, at least for conventional property acquisitions. We'll go into creative later through the presentation, but your initial money invested is your down payment, any agent commissions you're paying, any closing costs you're paying, and then most importantly, people forget to account the upfront rent-ready repair costs. So if you need to put $10,000 into the property before someone can actually live in it, because you have to replace all the flooring or paint all the walls or clean it out, that needs to be accounted for as part of your money invested before you can start generating your cash flow. So that's really the equation there. And the reason why cash on cash return is so important is it tells you how hard your money is working for you. The higher your cash on cash return, the better the deal is. That means you want a higher cash flow for less money invested, theoretically. I mean, that's the concept. The higher cash on cash return, the better. And to put it into terms that make more sense, if your property is generating you 8% cash on cash return, that means if you invested $100,000, you're generating $8,000 a year in annual cash flow, and it would take you 12 and a half years to get your initial investment back, right? That's what cash on cash return is. Really important to understand it from a payback period perspective. If you are getting 12% cash on cash return, it means you're making $12,000 a year in annual cash flow. It would take you 8.3 years to get your $100,000 investment back, and 50%, which is incredibly high, even with creative deals. It means that you'd get $50,000 back a year. It'd take you 2 years to get your initial investment back, right? So all the cash on cash return does is show you how hard is your money working for you, how quickly are you getting your initial capital back, and once you get your initial capital back, everything is further profit from there, right? So what return should you be looking for, right? This is something you have to decide for yourself, and that's ultimately up to you. I'll tell you what I look for, but and that's really dependent on the markets you decide to invest in. Typically, the better the market for long-term appreciation, the lower the cash on cash return, because you have to invest more money and typically you're getting less cash flow, at least up front. Things continue to get better over time, but this analysis is for that first year typically. So like in San Diego, you're maybe barely going to get any cash flow at all. You have to invest a decent amount of money to get that. Maybe somewhere in Kansas, you're going to get a much higher cash on cash return, but you're going to get less appreciation over time. Really depends on what you're looking for. My advice is to those that are building their real estate investment portfolio, you focus on cash flow first, and then you focus on long-term wealth generation and appreciation once you have that foundation of cash flow to sustain your portfolio. So for me, I look for at least $100 a month of cash flow per unit just as like a bare minimum, because if it's less than that, it's almost not even worth your time. Even if the cash on cash return is 1,000,000%, it's almost not really worth your time it's not worth your time to put in all that time and effort for like $50 a month, right? It might increase over time, but unless you have a good way of increasing it quickly, it's a time thing more than anything else. And then I'm looking for a cash on cash return of greater than 10%. So let me tell you why, right? So I also invest in the stock market, and the long-term annualized return of the S&P 500 is 9.8%, roughly 10%. that does not account for inflation, right? It's not inflation adjusted. But if I'm going to be investing time and effort into buying real estate, I want to make sure that I'm getting a higher return than I can passively get through stock market investing. There are so many other benefits of real estate that far exceed the cash flow alone, the cash and cash return. For example, I'm able to buy real estate through leverage. Whether I'm putting 20% down payment down with the bank and they're lending me 80% of that to purchase a property. So that leverage is huge, or I'm able to use other people's money to purchase real estate and use none of my own money. And I get the appreciation benefits, depreciation benefits, the debt pay down, all of those benefits that you can't get in the stock market. But from a cash flow and cash on cash return perspective, I'm looking to at least beat what I can get passively investing in the stock market. There we go. Yeah, I want to get at least the same return with the same return as the stock market with the bonus of the other three benefits, right? That's the bonus for me. So where do we go from here, right? You need to learn the market that you're trying to invest in. That's not what this is focused on today. You need to learn the market you're trying to invest in. What are the investment returns? Does that hit your criteria for what you're looking for? Or do you need to choose another out-of-state market potentially? You need to determine your investment goals. Like, as I mentioned, I highly advise focusing on cash flow starting out until you get a solid foundation and achieve financial independence, and then I didn't invest in San Diego until after I hit financial independence, because San Diego is not going to get me closer to my cash flow or early retirement goals, but it will build long-term wealth generation through long-term appreciation and lots of tax savings from depreciation. But you have to understand your investment goals, so your deals that you're buying align with that. You need to be hyper-focused on analyzing properties that fit your criteria as much as possible, whether you're looking at only single-family homes in certain markets, or you're looking at small multifamilies, whatever it is, you need to be able to analyze those types of properties and do it well. And then you have to, at some point, trust and execute. So the reason why it took me from 2018 to 2020 to buy my first property isn't because I wasn't doing all this. I underwrote over 100 properties before I ever bought the first one, because it took me that long to trust my numbers and to connect with other real estate investors to determine, is this hitting my buy box or not? So we're going to analyze a few deals now. So some of these are from various communities. Some of these are deals I've underwritten historically to give you an idea. And number 4 is actually a deal that we purchased in our business this year. So I wanted to kind of mix it up a little bit. Some of it is slideshow, and then the other ones we're actually going to go into the calculator and live underwrite them. The 3 creative ones we're going to live underwrite, and then the first 2 we're just going to kind of look at the slides, because once again, today's focus is long-term buy and hold real estate investing. That's what we're focused on. So a cash deal analysis. Everything I just said, you can kind of disregard for when it comes to cash deals, because unless you're putting in a ton of cash to buy a property and rent it out, you're not really looking at the cash on cash return. You can, but most people who are buying properties cash are doing so because they want the spread on equity. They want to buy a property that's worth $200,000 for $100,000, renovate it for $20,000, and then sell it for $200,000. That is what they're looking for. That's their profit once they sell that property. Your after repair value, ARV, is what the property is worth at sale. Your expenses are a multitude of things, including the price you pay to purchase the property, the renovation or rehab costs, holding costs. You're going to have to cover utilities, insurance, things like that. And if you're using other people's money, you're going to have to pay them interest on that money. You're going to have closing costs when you buy the property, and then you're going to have closing costs when you sell the property. And then if you bought it from a wholesaler, or there's an agent or someone involved, you're going to have to pay an assignment fee, an agent fee. So you have to account for all that in your expenses. And for cash deals, your return on investment is your profit, right? Let's say you make $15,000 and your expenses, which are, everything we listed there, and you had to invest $100,000 to get that deal. That's a 15% return on investment. That's what cash deals are focused on primarily. And that's why the concept of maximum allowable offer exists for people who are wholesalers or even buyers who are looking to determine, what price can I buy this property at to still hit my investment goals? So just to calculate that, it's the after repair value of the property, $200,000 minus the $50,000 of profit you're looking for, minus the $50,000 of expenses, which does not include your purchase price in this regards. Let's say it's $50,000. So 200 minus 50 minus 50 leaves you with $100,000. Means at most you can buy the property cash for $100,000 to generate your $50,000 of profit. That's your maximum allowable offer. Really high level stuff here. There's tons of great content out there for cash deals. I'm going to skip past this. There's just one quick deal we'll look at. Same concept. I'm actually not even going to waste too much time going over this. Same concept. Just put some numbers together for you to understand this type of cash deal and how you calculate your return on investment on a cash deal for your cash buyers. Next, we're going to go into a conventional deal analysis. And when I say conventional, that means you're leveraging a bank to take out a new loan to purchase a investment property. This is an example of a property that I actually did not buy. I didn't win my offer. Someone else offered more than I did, which is great. You do not want all of your offers accepted typically. Otherwise, that means you're probably overpaying for your properties. But if it hits your goals, that's what you're looking for. So this was a 3-unit, a 4-bedroom, 3-bath, 3-unit listed for $315,000. And as an investment loan through the bank, I was going to have to put a 25% down payment. So my upfront costs, oh, this is slightly off, but nonetheless, it's kind of the same. So my upfront cost, actually, it's $86,625. And that, with a conventional deal, is comprised of your down payment for the property, and then any closing costs you have, and any upfront repairs that you have to account for. Fortunately, this property was fully ready to go. It actually had tenants in place. It was nicely rehabbed. So there were no upfront repairs for it. At the time, you were getting 4.25% interest rate on these types of for investment properties, which is crazy now, right? A year or two later. So let's just look at how this deal penciled out. At a high level, right? You have your purchase price of $315,000. $78,750 is going to the down payment. Another $8,000 roughly to closing costs. Because it was a conventional deal, you and the seller were splitting the closing costs of 5% approximately. So you're basically paying 2.5% of that. And with your loan at 4.25%, your mortgage payment for the loan was $1,162. So what you have to do here is the same thing. We're focused on cash flow and your entry costs, right? So I got the rental income estimates from Rentometer and Bigger Pockets, and these were already being rented out for this value. Once again, this is Alaska, right? Very different market, very different than what a lot of people are willing to do. And we'll talk about deals all over the country, but this was an Alaska investment roughly 2 years ago, where interest rates were quite a different thing. So we estimated taxes from Zillow and the county using the county's website. The other expenses, we leveraged the profit and loss statement from the sellers on what they were currently paying for. Since this was a multi-unit, there were some expenses that you had to cover as the owner because they were not split up, and we're estimating the standard reserves. So this property had 2 1-by-1 units, 1 2-by-1 unit, and in total, the rental income was $3,600 a month. Your expenses comprised of your, not this amount, right? You have your monthly loan payments, which we talked about in the last slide, and it'll be summarized in the next one. Your property taxes, your insurance, the utilities that you're responsible for, heat and water were not separated per unit. So you as the landlord had to cover that. Your 10% towards management, 8% towards vacancy, and then your remaining 10% towards maintenance and CapEx. And just at a high level, this property, the income minus the mortgage or the loan payment on the mortgage, the expenses, the reserves, left you with $405 cash flow, right? That hits my greater than $100 a month cash flow per unit, right? This one cash flowed like $130 something per unit. So that hits that metric. But the cash on cash return for this property was 5.61%. So as I mentioned, I'm looking for 10% cash on cash return. I will say one thing to account for is your reserves are, you're setting those aside, but those are kind of the worst case scenario typically if there's not a lot of unexpected expenses. So on the kind of the worst case scenario, you're making 5.61% return on your money. On the best case scenario, let's say you have no reserves you have to tap into, you're looking at 14.59% cash on cash return on your money. For some people, that is a good investment. And I'm not saying you shouldn't invest on deals like that. It's ultimately up to you and what you're looking for investment criteria. I really, really like to understand what my cash on cash return is with my full reserves accounted for. If we do have a month of vacancy per unit, if we do have to use our 5% maintenance, 5% capital expenditures, what would my returns look like? And then if I didn't have to use that, what does it look like? It gives you kind of a worst to best case scenario on your investment. And I did like that it was turnkey rental and ready to go. But this is just an example just to kind of underwrite a conventional deal, kind of what you're looking for. In this scenario, right, just because at this purchase price of $315,000, it does not mean you have to purchase it at $315,000. The one lever you have on conventional deals really is how much, what purchase price you're willing to offer and what credits you're asking for from the seller, so they can help you with your entry costs to reduce some of your closing costs. So in this conventional deal analysis, your offer could be what it was. Maybe you're looking to hit an 8% cash on cash return goal. You would need to figure out what price it takes to get that 8% cash on cash return goal. And in this scenario, it was worth around $315,000. You need to ask for around a 9-10% discount to get your 8.41% of cash on cash return. So that's the lever you have with conventional deals. You can ask for a lower price, you can offer a lower price, and you can ask for seller credits to help reduce some of your entry costs. But you're pretty fixed in the bank tells you what your down payment percentage is. The bank tells you what the terms of your loan are. The bank tells you, all that stuff. And then you have to get approved for it as well. And it's ultimately up to you. Like, the reason why I didn't purchase this property is I offered over 10% below asking. Someone else bought it at fair market value. That's great. It hit what they're looking for. It did not hit what I was looking for. I thought, it didn't make sense for me at that price, but it's ultimately your call. This is why it's so important to understand your investment criteria, so you stick to it. You need some kind of North Star, some type of guiding light when you are trying to make offers and make sure you're offering what makes sense for your buy box. Escalation clause, none of that matters right now. So once again, the number of levers you actually have for conventional deals, there's a variety of levers you can pull when constructing a deal. But for conventional deals, your purchase price and your entry costs are really all you can ask for. And to be honest with you, now I just reran this at 7.5% interest rate. Your cash flow that was $400+ a month and cash on cash return at, what was it, like roughly 6%, is now at 7.5% instead of 4.5%, which is still a good interest rate for an investment loan right now. Your cash flow is negative $85 a month, and your cash on cash return is now negative. I'm not saying this still doesn't hit some people's buy box. It might. Maybe someone who's willing to lose $100 a month in the worst case scenario for the other benefits of real estate, but it sure as heck does not hit my buy box. I'm not looking to invest, was it almost $100,000 to then lose $100 a month, right? Regardless of the other benefits of real estate. But it's ultimately up to you. And you'll see people buy deals like this. Maybe they have a ton of money and the tax benefits are more important, whatever. This is why it's so important for you to understand why you are buying and what you are looking for to hit your why. But fortunately, creative financing to save the day. So creative financing there's a variety of creative financing acquisition strategies that allow for you to better customize your real estate investment purchases, so that it might hit your buy box more straightforwardly. So the different creative financing methods, some of them include seller and owner financing, purchasing a property subject to its existing mortgage, purchasing the property hybrid between a seller financing and subject to. So let's say they own they're selling it for $300,000. They have a $100,000 loan in place, which you are going to be basically assuming the responsibility or the payments of. That other $200,000 is you're going to pay some portion of a down payment to them. And then you're going to seller finance the remainder of that, right? That's what a hybrid is. There's other acquisition strategies that we're just not going to go over today. There's not enough time, especially if I want to do Q&A and live underwriting with you all. But I've basically done the majority of real estate investing strategies. But the ones that I focus on primarily now are cash deals, seller financing, subject to, hybrid, Mortgage methods, but interest rates are high. And you have to still work with banks on Mortgage methods. So I do that a lot less. debt service coverage ratio or DSCR loans, things like that. So let's get into it. At the highest level, seller financing is a type of real estate agreement that you're basically purchasing the property from a seller who owns the property outright, or they have a low enough mortgage or debt in place that you can pay it off. And the bank now, and the seller now becomes your bank, right? So this is my favorite type of acquisition strategy, because as I mentioned, the levers for purchasing properties conventionally is purchase price and the amount of seller credits you ask for. With seller financing, if they own it outright, every single thing is fully negotiable. And that's why I got into one of our really good examples later that shows you everything all the levers I pulled to turn a deal that wasn't to one that was. And that made me and my partners a good amount of money, and will continue to do so over time. So you are structuring the terms with your seller directly, the purchase price on the property, the down payment on the property. I never like to bring up interest rates. Ideally, I like to talk about what is the monthly payment you're looking for, which is then comprised of the loan amount, the interest rate, and the amortization schedule, or the number of years it would take to pay off that loan. And then if there is a balloon, basically, if you are required to pay off the full mortgage, the full loan at a certain time before the loan is fully paid off. So maybe it's amortized over 30 years. Theoretically, over 30 years, you pay off that loan, but they want the full payout at the 10-year mark. That's what your balloon is. Another one is subject to financing. When you're purchasing a property subject to its existing loan, you are essentially taking over the seller's remaining mortgage, right? You're taking over responsibilities for payments on the loan. You're purchasing the property. You are the owner of the property, but the loan stays in the seller's name, but you are the one that is making payments on behalf of the seller, and you're never making that official with the lender themselves. This type of scenario is common when there is some level of distress with the seller, some type of motivation that they're willing to just give up their loan and move on. And typically they don't have a lot of equity and they need to sell, they have a job transfer, whatever. And this is a perfect example that 3-unit that we talked about in Fairbanks. If you were to purchase that property now, you'd have to pay a 7.5% interest rate. But let's say the seller has a 4.5% interest rate. You can buy the property from them with that existing loan in place, and then figure out what you're going to do on their equity, like pay them out typically in a straight subject to deal. That's how you can make a deal out of something that won't make sense now, but it could have made sense at a lower interest rate. But just because you're able to purchase a property subject to or seller finance or anything creative does not still mean it's a good deal. It is your job to determine, does this property underwrite for what your buying criteria is? And Roy, we will do all questions at the end, my friend. The terms for financing are already established with the type of acquisition strategy. So if you're taking over someone's loan, they already got the loan from a bank, from a third party. So when you're taking over the payments on that, there are a lot less levers to pull. We'll go over what some of those are later, but there's a lot less levers to pull because you're taking over their loan. The loan is already fixed. You're paying what the bank and you agreed, or the bank and the seller agreed to pay when they purchased the property. And then hybrid is just a combination of subject to and seller financing. This is the most common because, especially over the last couple of years, especially the majority of deals that we buy, typically if the seller bought it 1 or 2 years ago, the market has appreciated enough that they have some equity. You can choose to pay them out fully on that equity. But if I don't have to pay someone $100,000 to purchase the property strictly subject to, and I can seller finance that and pay them $20,000 and make small monthly payments on their equity, I would much rather do that because of the cash on cash return calculation. And we'll go over that when we go to the underwriting. That's what hybrid is, a combination of subject to and seller financing, which is the most common. Okay, so analyzing creative deals. Look at this. Same concept for the most part. Your cash flow is the same calculation. It's your income minus fixed expenses minus variable expenses or your reserves. In this scenario, well, we'll go over for the different properties, the different acquisition strategies. What are your expenses that you have to account for? Really, the expenses are all the same except for the debt payments. That is where you can get creative. And that with subject to, it's more straightforward. So financing, you can start leveraging the different levers to make that potentially a deal for you. And then cash on cash return is your annual cash flow. but now we divide it by our entry costs. Same thing, right? It's your initial invested capital, but entry costs are a lot more complex when it comes to creative deals, typically. So especially if you're buying them from a wholesaler, there's an agent in place. There's a lot of other things you have to account for that you may not have accounted for when you're purchasing conventionally. So your entry cost. So I consider entry cost as 8 different parts. So, we're taught 7 typically, but I split this up a little bit more. So first is any cash to the seller that you're paying them outright, a down payment to the seller. Any arrears, which is common if you're purchasing a property subject to its existing loan. There is typically going to be some type of motivation, one of which is the seller is behind on mortgage payments. They have liens in place. You have to account for that if you're going to be paying that off to purchase the property. If there is an agent in place, you're going to have to pay them. Typically in these scenarios, you're going to be the one to pay the agent, or you have to negotiate that with the seller. I like to ask the seller to pay for that through the amount of money that I'm giving them as the down payment. Any rehab, renovation, cleanup, furnishing costs, whatever it takes to get the property rent ready. Any closing costs. So, if you have to use closing attorneys, title companies, escrow companies, transaction coordinators, I include an ad. So that we consider marketing as the cost to fill the space, but I really like to include admin costs in there as well, because typically if you're buying a property and you're a savvy real estate investor, you're going to form an LLC to acquire the property. You're going to be paying for an inspection, all those things. You want to account for all your costs to enter a deal. An assignment fee if you are purchasing the property from a wholesaler, and then carrying costs. So your carrying costs are the money you have saved on the side while you're trying to get your property operational, whether you have to rehab it or find tenants. You want to have that money saved up front so that you are not putting yourself in a position in which as soon as you buy the property, you have no money to make a mortgage payment if your property's sitting there. You want to set yourself up with the right foundation. You want to know exactly how much you should be raising for those. Cool. So let's start doing some deal analysis. So this is a deal that was in our sub-2 community. This is a wholesaler brought the deal. They said that here's all the information that you need. You don't need any more information. That was everything on the left-hand side. There was a lot more information you needed to actually be able to underwrite the deal. What you'll notice is if you're not good at underwriting and you're just plugging in the numbers based on what a wholesaler is telling you, a wholesaler or an agent or whoever, they don't really care about you. Not in a rude way, but they are there to sell you a deal, right? They are structuring a deal with the seller and they want to sell you a deal for you to acquire, and they make money if you buy the deal. So maybe they'll skip certain parts of it. Maybe it's not even their job to tell you that you need to account for all these things. It's your job as the buyer, as the investor, to know how to underwrite a rental property thoroughly and effectively so that you are not risking your money or someone else's money. Too many people buy properties based on what other people tell them, and that's stupid, like so stupid. But get confident in your ability to underwrite deals, understand what is an investment, what information might be missing, what information might be inaccurate, so that when you make an investment decision, you should only hold yourself accountable for your investment decisions. So let's get into this. So I'm going to minimize this. I know it's a lot right now. We're going to actually, let's see if we can slideshow, but then do a partial screen. Perfect. Yes, we can. Can someone give me a thumbs up if they can see both the calculator and... Awesome. Okay. So the terms of this deal. So this is a property, and this is the creative real estate investing calculator that Esteban and I created. And our awesome team helps us out a lot with this as well. This is, in my opinion, the most comprehensive calculator out there to underwrite for various creative acquisition strategies. You can also underwrite for conventional deals. You get an instant cash offer calculator there, but this is a very thorough calculator for underwriting subject to deals, seller finance deals, hybrid deals. And, we just as a quick overview, right? It's your property information section, your after repair value, basically a way for you to quickly determine what the property's value would be based on comps. And you have an ability to track all that here. Your creative purchasing purchasing calculations. This is your purchase price, your seller finance loan terms, your subject to loan if you are taking one over. You have your cash flow analysis, which includes your rental income as we described, right? So that's where we built the foundation to go over this, and hopefully everyone understands this now. Your rental income, your expenses, including your debt payments, taxes and insurance, HOA if there is one, and any expenses that you have to account for. Your other expenses, which include your property management, and if you're leveraging private money lenders to purchase that property, right, using other people's money at a fixed interest rate to pay them back to purchase it. And then your reserves, as we described earlier. Your 8 entry costs here, and then a variety of ways to analyze your deal. Typically, like I said, we're focused on long-term rentals primarily. Even if I'm buying a property to short-term rent, midterm rent, whatever the exit strategy is, I want to fully understand how this property performs as a long-term rental. I do not, unless the property is a insanely amazing, huge cabin in the Smokies or something like that, that really makes it stand out. I don't want to buy a property and overpay for it. Pay the seller way more than the property is worth, if there's a risk of me losing money as a long-term rental. Unless it's like such a standout property, don't risk it. Don't risk everything for a not great deal. You know, you're investing your money or someone else's money for that. And then there's the different exit strategies. We're not going to be going over this in this training today. We will be going over all of the acquisitions right here. We're going to go over some of the balloon calculators here. We're going to go over the income and expenses. We're going to go over breaking down the various entry costs, and then we're going to analyze it from a long-term rental perspective. Okay. So let's start for this property. This is our sub 2 deal demo. So we are going to be doing this Conroe, Texas property. Once again, a wholesaler listed this and said, you have all the information you need. They provide you what was on the left, except for a breakdown of the principal and interest. I had to look some information up on PropStream. Today is a high-level overview. I have stuff coming out in the future. It's going to really go into the nitty-gritty of how do you find this information that's not provided by a wholesaler or a seller? How do you double check all this information? Who are the people you reach out to and contact to get some of this information? But for the time being, we are going to go with what was provided. So Conroe, Texas, it's a 3-bedroom, 2.5-bath house, and it is 2216 square feet. We're going to leave it at that. We're not going to worry about days on market, original list price, current list price. None of that matters for this scenario. We're not going to look at this from an after repair value analysis. We're strictly going to underwrite this as a straight sub 2 transaction. And I'm going to show you exactly how to do that. So there are 2 ways to underwrite your sub 2 loan, right? If you have the original loan terms, this calculator, if you know what the original loan amount was, the interest rate, it's either usually a 30 or 50 year or 15-year term on the loan, most commonly a 30-year term, and the first date they made the payment, this will automatically calculate for you your principal and interest payment for that loan. And then from there, we have the amortization schedule that breaks down for the full 30 years what the loan looks like at the time of purchase, and then up to the point of you bought it, and every single month it continues adjusting for as the loan continues to go down its amortization schedule. So in this example, he told us the purchase price is $252,000. So let's start with that. So all you do is plug in your $252,000 here. He said the cash to the seller is $16,000. So that's your down payment. You're paying, $252,000. $252,000. A portion of that is your cash to the seller. So you're paying them $16,000. No. We have all right, so our principal, interest, taxes, insurance is what was provided to us. They said it was $1,850 a month. That's not very useful. You want to understand the principal and interest, the loan itself, separate from the escrow, because you want to understand that the escrow payments are going to be your taxes and insurance, and if there's any PMI included. They didn't even mention that this was an FHA loan, so there is PMI included. So of that $1,850, I was able to gather that $1,095.20 was principal and interest, and the remainder is your escrow of that $1,850, assuming this number is correct. This is why it's so important to have a mortgage statement, ideally, to be able to verify this stuff, because people post whatever And before you ever purchase this deal, I would highly advise you to verify with a mortgage statement. If you're purchasing property subject to the existing loan, you want to verify the information on there. So the remaining sub 2 loan, they said the loan itself was $252,000. So actually this purchase price is $250,000 plus $16,000. So this down payment typically is, you just put a percentage here and it'll give you the value here, or you can just overwrite that. If you want to know what the percentage is of the 16,000 divided by the 268, you just click equal, and then you do 16,000, you do the 16,000 C27 divided by 268, and that'll tell you what the percentage. So you're paying a 5.97 or 6% down payment. Let's see what other information they provided, and then we'll go back and fill in with the information that I was able to identify. So let's go to the entry cost. That's what they next provided. So the 16,000 automatically gets put here as the down payment to the seller. They stated $10,000 in arrears. So there's a loan that you will have to pay off. There is no agent involved, so there's no agent commission. They say the property is in perfect condition. There's no rehab that's needed at all. I typically like to at least put $500 to $1,000 for just a basic cleaning at minimum and some drywall touch up and things like that. Closing costs. So we'll estimate that typically in these types of creative transactions, the seller really doesn't have a lot of money to cover these closing costs. So you're typically the one responsible for it. We have it automatically here at 3%. I put at least $500, ideally $1,000 for your admin costs for creating your LLC and for the inspection itself. And they're asking for a $10,000 assignment fee. What you'll notice is they are not accounting for your carrying costs, which are just money that you have in reserves to cover your expenses for the first few months, right? So this 1425 is this value and expenses here. That is your loan payments and any utilities you have to account for. So assuming it's a perfect property, it's going to get rented out in a month, you can just change this to 1. I advise at least having 1 month in reserves. And then we are good from the entry cost perspective between what the seller or what the wholesaler provided, plus what we are estimating, right? In closing costs, I guess I put 2.5% here. That's fine. You just change that. And then the carrying cost. So I just put a month here. It's fine. So let's go through the expenses that were provided. So we know that there is an HOA, right? A homeowners association you have to make payments on. So you're paying them $20 a month, or so 20 times 12. Right, you can just put the 20 here and just put the 240 there. It's your call. Typically, we have them in years and then it divides the monthly amount here. Once again, they do not break down the principal, interest, tax, and insurance, but because of PropStream, I was able to pull up some information. Oh. So we're going to go into the original loan amount was $260,101. Their interest rate was 2.8%. 30-year term, and their first payment date was 12/1/2021. So you really want to understand that. And it's saying the monthly mortgage payment is $1,068.74. So I think there's a slight discrepancy between the PropStream interest rate that they have versus the one that the seller has or the wholesaler has. We're going to just assume that 2.8% is right. This is your initial underwriting to see if there's even a deal before you do deep underwriting with the mortgage statement and all that. So it says $1,068.74 a month. So that's right here. In this instance, is a straight sub 2 deal. So there is no seller finance. This value should be 0. So the amount here should be the same amount as should leave this at 0. So we're going to put the $252,000 loan remaining. We can verify if that makes sense by looking at our amortization schedule and where the last green is and see if this corroborates. Because this loan has arrears, they haven't made payments. It's not actually going to be at this. The amortization schedule doesn't account for that, right? It doesn't know that they should theoretically be at $248,714 is where their loan should be, but they haven't made payments in a couple months, right? That $10,000, they haven't made payments in, let's say right around 9 months, right? That accounts for the value that you're basically taking over. So the loan you're taking over is $252,000. So you'll see it between the purchase price, the down payment, and the loan you're taking over, there is no more equity left to the seller, right? It's a straight sub-2 deal, so there's no seller finance. There's no more cash you have to pay out. So all of this stuff is zero. There's no seller finance portion. This 1068.74 is automatically put into your sub-2 P&I right here as your expense, zero seller finance. And then now you have to account for the other expenses. Of the 1850 that the wholesaler told you about, you're paying $1,068.74 to the loans itself. So there is property mortgage insurance because this is an FHA loan. So you have to understand the different loan products. FHA loans have property mortgage insurance included in them. And that's kind of a wasted fee because you have less than 20% ownership of the property and you're leveraging a FHA loan. It's because you're putting a lower down payment, it's kind of a fee you're paying as like a security for them giving you that type of loan. So we're going to do some estimations here. We know there's roughly, so it's, we'll just write here equals 1850 minus this mortgage. Oh, I didn't click an equal sign. So you're going to click equal 1850 minus the monthly loan payment. Why is this happening? All right. Minus, we'll just say this 1069 right here leaves you at $781. So your taxes, your insurance, and your property mortgage insurance are going to be $781. You need to be able to get this information from the wholesaler. Typically, if they have it under contract, they should have some of this information. On a mortgage statement, it shows you exactly how to do it. I cannot show you a mortgage statement in this training since this will be shared and uploaded. I cannot share with you someone's personal information like that. But we can take the 781 and do our best to estimate what it is here. So it's going to be the combination of the taxes, insurance, and PMI. So at minimum, we can put roughly $200 for PMI, right? So that leaves you at minus this $200. There's 581 left. Looking up on, where did I look this up on? Looking up on PropStream, I was able to figure out for 2022, the taxes that were assessed were $6,030, or that's the tax they paid for an assessed value of $285. It's currently assessed at $305, and the taxes will be some proportion of that. We're not going to go into county websites and all that right now. Right, that's stuff we can discuss at a later time. But currently, the property taxes are $60.30, and the assessed value was $285. It's currently being assessed at, or it's being assessed at $305,000. Oh, I keep missing zeros today. So it's saying the tax will go from $60.30 to $64.53 a month or a year. So you can change that to $64.53. So that's $538. That's taking up the majority of this. So maybe this PMI is significantly lower. I don't know. We'll put $50 for now. So it'll be your $731. This is why you need a mortgage statement, because it's so hard with, this is why it's so frustrating, right? A wholesaler tells you, here, you have all the information you need. They're saying you can subtract your rent from your PITI to determine what your income is, but you don't actually fully understand the deal. If we just did that, you would be missing a lot of steps and you'd be missing a lot of the entry costs. You want to be able to understand this stuff at a higher level, but that is a quick way to filter, right? They're saying $2,100 in rent from PropStream minus the $1,850. That gives you that cash flow of, what's that? $150 to $250. Right. And that doesn't count for any reserves or anything. I can already tell you it's not a deal based on that small spread, not even accounting for the HOA and things like that and the amount of money you'd have to put in to buy this deal. But let's do the 731 minus this 538. So it's 194. We'll say the rest of the 194. Here, let's change this to 100. And there's 144. We'll say the insurance is 144. So you want to just do the 144 times 12 because you're putting the monthly amount, right? Hopefully that makes sense. We are taking the loan amount, the principal and interest, subtracting it from the principal, interest, tax, and insurance that was provided by the wholesaler, right? Until we can get a mortgage statement, get a better idea. And then we're estimating what is going towards principal, mortgage, PMI, what are the taxes, and then what is the insurance? And $144 is reasonable for insurance costs as an estimation per month for a single family home. and they're saying $20 HOA. Because this property is a single family home, you're probably not responsible for any of the other expenses. You might cover landscaping, but you can put that on your tenant. The things that you cannot avoid are property management. Even if you're going to self-manage a property, it's really important for you to still account for that property management, because you're not always going to want to self-manage your properties. Your vacancy at 8% and your maintenance and CapEx at 10%. So based on the information provided by the seller or the wholesaler, they're saying you have a rental income of $2,100 a month minus your $1,850 for property mortgage insurance minus $20 a month for HOA, right? They're telling you you're making $230 of cash flow. When you start really diving into it and accounting for your reserves, we'll see what that actually looks like. The rental income here, it's 1 unit, right? And the rent is $2,100. And see, so your everything, your property management, your vacancy and CapEx are determined by a percentage of your rental income. So that's why these percentages are there. They are a percentage of your rental income that you're collecting. We have accounted for all of our entry costs, right? So just a quick summary. We have our purchase price of $268 minus the $16,000 down payment, and we're taking over a $250,000 loan at 2.8% interest that was purchased 12/1/2021. Theoretically, if there is no balloon, which there is not in this property, you will be able to keep that loan until 12/1/2051. So you have 28 years, 27 years left of this loan. You have your sub-2 principal and interest payment that you're paying each month. Your PMI, property taxes, and insurance were accounted from the difference between the PITI provided by the wholesaler and your monthly loan payment. We did our best to estimate the taxes based on the assessed values last year and what they paid versus this year and what we anticipate they will pay. We accounted for our reserves, and we accounted for our entry costs, including what was provided and what we need to account for as buy and hold investors. And so this deal, which theoretically, they would say, hey, you're getting $230 of cash flow a month. Well, realistically, you're actually losing $358 of cash flow when you account for your reserves and your entry costs, where they might state it's $36,000 here. It's actually closer to $46,570 when you have to account for your rehab, your carrying costs, your closing costs, your admin costs. These are things that they're not accounting for because it makes the deal look better, right? If it was 30, so based on this cash flow of negative $358 or a negative 9.24% cash return, I think most people would not want to buy this, right? Even if you reduce this entry cost to what they stated at $36,000, actually, let's just show you what their underwriting would have showed. Their underwriting of $230, 230 times 12, this is your annual cash flow, divided by the and then your $36,000 entry cost. They would tell you this is a 7.7% cash on cash return deal, right? That's the values they're providing. You need to be able to understand how to more thoroughly underwrite, so you know that you're accounting for all the right entry costs, all the right expenses to determine what's the real cash flow that you can anticipate, right? This is your worst case scenario, accounting for all your maintenance, CapEx, and vacancy, all your reserves, and someone else is managing it for you. But even if you had no reserves, on the best case scenario, you're making maybe $20 a month. For a cash flow and cash on cash return investor, this is definitely not a deal. So this is why it's so important to do your own due diligence and not just do something like rental income minus property PITI. You have to account for a lot more than that. So this is a sub-2 example, a straight sub-2 deal. Next, we're going to move on to, does anyone have any questions about sub-2 real fast? Anything about this sub-2? We can actually do a few questions right now. Just raise your hand and I can unmute you. If not, we will move on to seller finance and then hybrid. Okay, Roy. Go for it, Roy.
Yeah, can you hear me?
Yes, we can.
I had a question about somebody told me to be aware of when you want to sell the properties, could be any problem with the seller, intervening and wanting more of the appreciation? because I heard like subject to is pretty new, and there's not a lot of like cases where people like had it for 10 years and then sell it after 10 years or something like it, and that you should be aware with the contract on how to do it, because it could be a problem if you want to sell the property.
Yeah,
Um,
I've not heard that as a concern, but you mentioned a key point there is using the right contracts, right? You need to ensure that your contracts account for all that. I leverage transaction coordinators and title companies that are very, very familiar with creative financing, subject to seller financing, and all the other creative acquisition strategies that we leverage. So we ensure that a lot of that is already included in the contract, and my transaction coordinators ensure that we're using all the right documentation to protect ourselves. At that point, you are purchasing the property from the seller. Title is in your name. Even though the loan is in their name, you get all of the benefits of the real estate investment. So if you buy for 200 and that's the loan amount, and it's 100,000 by the time you sell it, and you sell it for $400,000, that $300,000 is yours, right? I mean, obviously taxes and all that, but that profit is yours. That's more of a general. It's more of a general question, but yeah, does that help you at least for now?
did you sold any subject to that you purchased?
I'm a buy and hold investor, so I do not like to sell anything if I don't have to, because I get all the other benefits of real estate, right? And usually you're not walking into a ton of equity with these transactions. I mean, some of ours you do, but I've not sold a property because I like to hold and retain my properties because I'm buying them at values that make a lot of sense for me upfront. What I would sell a property, I'd more likely refinance it if I wanted to pull equity out of the property, or it's got so much equity that refinancing wouldn't make sense. And I want to realize that I would sell a property. It just doesn't make sense for any of my portfolio to sell. I've sold properties before, but not a subject to deal. Because I'm usually buying those, at 2, 3, 4%. Like 2, 3, 4%. So like, why would I sell that when my alternative is to buy something at 7, 8, 9% conventionally? Cool. We'll do more Q&A at the end. Let's get Edgar's question. Edgar, you got a quick question for me? Oh, whoops. I got to ask you to unmute.
There it is. Thanks. Well, first, thank you, Michael, for putting this together. Appreciate it, man. Hey, I don't know if I missed it, but I just wanted to make sure I understood correctly. Where it says cash flow without reserves, can you clarify that again, what that means?
Of course. So I show the conventional underwriting example first and foremost. Your cash flow is your income minus your expenses, minus your property management expenses, right? And then you also subtract away your reserves right here. Hopefully you guys can see me highlighting. And that is what this cash flow amount is right here. That is the most accurate way to underwrite these types of our buy and hold real estate investing. You want to account for all of those parts. However, that's essentially your worst case scenario. If you have 1 month of vacancy a year per unit, you have to use your full 5% maintenance, and you have to use your full 5% capital expenditures, or you're saving for it at minimum. Your cash flow without reserves is basically adding back this $378 of reserves that you have here. That's all it is. It gives you kind of your net cash flow. How you should be calculating it is essentially your worst case scenario, as long as there's not some kind of crazy black swan event. And then your cash flow without reserves is if you didn't have to account for those reserves, kind of your best case scenario. And I like to look at it from the worst to best case scenario to determine, does that hit my buying criteria? I don't always only look at it at the worst case scenario. I also look at it as, okay, if it's worst case scenario is 8% cash on cash return, best case scenario is 22%. Yeah, I'm willing to take that bet, because after owning and acquiring, the 40 plus properties and being part of lots of transactions, you're usually somewhere in the middle of that at the end of your first year, second year, and things continue to improve in value over time, right? Your rental income goes up, property values go up, and you have all the other benefits of real estate. So that's why I like to look at it from the worst case scenario to the best case scenario to understand. Does that make sense?
Yep. Perfect, man. Appreciate it. Thanks for clarifying that.
Yeah, no worries. So there's a question here in the chat. What would arrears be? So this is, they didn't make roughly $10,000 of loan payments on this one. So you're back paying the mortgage payment that they didn't do. When I pulled up on PropStream, they were on they're in pre-foreclosure. So that further confirms that this property had monthly mortgage payments that they were not making. I think it was right around 5 months of mortgage payments they were making. So I'm going to move on to the next one because we have 2 more deals to underwrite and I want to do stuff for you all. No, if the new owner, yes, the new owner does get depreciation benefits if the property is purchased subject to, because your name is on title. You are the one that actually owns the property, even though the loan is under the seller's name, right? Ownership is different than the loan, the mortgage. So the next deal, this is one of the deals that we bought earlier this year. It's a straight seller finance deal. And I will show you how we took it at face value, underwrote and said, it's pretty close to what we're looking for. And then how I was able to make it a much better deal for us. So this one is Atlanta, Georgia. I love small multifamily. That's my bread and butter. 2 to 4 unit properties, because you have the good residential loans in place that you can take over subject to, and you have the, and usually you're able to get much higher cash flow because economies of scale and all that. So we have, this was a 5-bed, 4-bath. Oh, oops, 5-bed, 4-bath at 3,100 square feet. So it's a 3x2 and a 2x2 top down duplex. Our purchase price for the property was $450,000. I know it's a little confusing. The slide has a lot of arrows in it. I'll explain all that. It's how I was able to navigate the deal and make it make sense. The seller was asking for a 10% down payment, so $45,000. This was actually brought to me from a wholesaler and friend of mine. I you know, good friends with lots of people, and they bring me deals because they know we're good, trusted buyers who close on deals. So down payment was $450,000. Because this is a straight seller finance deal, there is no subject to loan for us to worry about. So what I do here, I take this monthly loan payment, I override it and put 0, because there's no subject to loan to worry about. I take the sub 2 loan that we're taking over and set it to 0, right? So now it says your seller finance loan is $405,000. The seller was offering 4.5%. This is what was negotiated to, 4.5% interest rate, amortized over 30 years, right? If we paid it back in full, the loan would be paid back in 30 years, but they wanted a balloon in 7 years. So whatever the final amount was. So here you're going to change the balloon term to 7 years. And this is showing you that in 7 years, assuming all this is, you know, $405,000 loan, your first payment date, I guess don't worry too much about that, but like you'll want to put that when your first payment date is. This is backtracking, but well, I guess it doesn't really matter. So we'll do 1/1/2024. Your balloon payment in 7 years of this $405,000, you'll be paying them $355,000 and $351,000 is what you'll be paying them at the end of 7 years to pay off the loan. Typically, you'll refinance it to a different loan product. You'll sell it, pay back the loan, you know, all that kind of stuff. There's options for that. I'm not going to get into that today. So this was the deal. This property is 2 units. And the rental income was, so you can click equals average. So it's a 2-unit property. So the average of 2,500, comma, 2,200, right? So it's the average of those 2 times 2. So we're generating $4,700 a month in rental income. We have the seller finance loan here, taxes and insurance. So taxes were $4,900 and insurance is $3,000. Because it's a multifamily unit, the electricity could be actually, because it was 1 electric meter and 1 water meter, we have to account for those costs. So that was $250 for water, $200 for electricity. This is going to be a lot of plug and play. And then I'm going to go really into how we made this a really good deal. 10% property management, 8% for vacancy, 10% for maintenance and CapEx. So our total entry costs were the $45,000 down to the seller. There was no agent, so that was 0. This is an off-market deal. I still account for $1,000 for basic cleaning and all that. And actually, we bought this with tenants in place, fully renovated, fully clean. If there's ever a time to put 0, it was on a deal like this one. Our closing costs are, we split some of it with the seller, so it was around 2.5%. or maybe closer to 2, let's see. Yeah, 2.5% is what the estimation was for this. So it's split. Our inspection and our LLC costs were around $1,000. Our assignment fee to the wholesaler was $10,000. And because this property was already rented, ready to go, turnkey, we were just buying a cash flowing asset. I only account for 1 month of reserves for that scenario. And that's just to make sure that we have at least 1 month of full expenses to cover. And because it's a multi-unit, typically you don't have everyone move at the same time, especially if you're not drastically changing anything. So yeah, this shows what our initial entry cost was. This shows what our initial expenses and income were at the terms originally negotiated to purchase the property. So this shows you our income, $4,700, expenses $3,160, property management $470, and $846 for maintenance, capex, and vacancy. Right? The net cash flow on this property is $224, so it hits our criteria of $100 per unit in cash flow, but the cash on cash return was definitely a lot lower than what I was looking for at 3.76%. So what I did to make this a better deal is I always take my inspection report and I leverage that, right? If we get this far, I will leverage that to see how can we make this a better deal? And usually what I'm looking for is with seller finance, how can I reduce the interest rate as much as possible? I don't want to waste money on interest. How can I reduce the purchase price? How can I, whatever I can of those multiple levers, what can I do? So the first thing we did is I leveraged that $500 inspection report and estimated around $20,000 in repairs. And I told the seller, hey, what we can do is instead of you coming out of pocket and paying $20,000 for these repairs for me to close on this deal, what we can do instead is we can reduce the interest rate. I think I said to 2.5%. He said, no, I'm not comfortable with that. We're at 4.5. And we agreed at 3.5%, which for me was, you want to anchor somewhere low, right? And then you definitely want to anchor somewhere lower because you're never going to get the first number you offer. So we went from $2,052 in monthly seller finance payments to, so that was to 3.5%. Oh, I'm sorry. This is actually a different, because this was a furnished rental and we were able to get that additional long-term rental income as a furnished rental, there's approximately $15,000 in rehab costs or furnishing costs primarily here. So actually your returns are even worse. It's 3.14% cash on cash. Doesn't affect your cash flow, but it definitely affects your cash on cash return. So the first thing I did was leverage the $500 inspection report to reduce the interest rate from 4.5% to 3.5%. That saved us, that took us from $2,052 in principal and interest payments to $1,818, right? So you need to understand these levers. What did that do? That gave us an additional $200 of income on the property. So we went from roughly $200 of cash flow a month to $457 of cash flow a month. Brought our cash on cash return up to 6.44% just by increasing our cash flow, right? It's so important to increase that cash flow. Could I have asked for $20,000 off and focused on that? Yes, but that actually wouldn't have changed my deal nearly as much. And let's just see what that looks like. So from cash flow of 457 and 6.44, if I asked for $430,000 loan, well, man, I'm just like 1-0 off every time. My cash return is only 5.49% and my cash flow is 315. So asking for a 1% interest rate, and these are the things you want to think about. What's going to affect your overall returns much more than just for asking for $20,000 off. If you're thinking about buy and holding long-term, you really want to understand what are the levers you need to pull to make a deal that may not seem like a deal, especially seller finance ones, into something that works a lot better for you. So let's get back to what we did. So we changed it to 3.5%, understanding that would have a bigger impact on our cash flow and cash on cash return. So when I talked to the seller, I said, hey, so you mentioned this property's furnished. What is your plan with the furnishings? And he says, well, I don't know, it's over $15,000 to $20,000 of furnishings. We want to take it out. And I said, okay, well, what's your plan to do that with the tenants in place? And he was kind of stumped. He didn't know what to do. He didn't, there's existing leases in place. And I said, well, what if I buy the furnishings from you as part of this sale? And we negotiated, and I said, well, I'm really only looking to pay $5,000, and I'm not looking to pay that $5,000 up front, right? Whatever you can do to reduce your entry costs is going to have a huge impact on your cash on cash return. And I said, what if we just finance it the same as everything else? I mean, it's going to save you the hassle of having to worry about what to do with your furnishings. You're going to, it will keep it nice and convenient for your tenants, and or like the existing tenants, we don't have to mess with them, and you'll make money on this thing and interest. So I actually increased the purchase price, right? I increased the purchase price from $450,000 to $455,000. We still only paid $45,000 down payment, because that's what we originally agreed to. So your down payment percentage has gone down a little bit to 9.89%. But I'm basically took myself from 2052 principal and interest payment to 1818 to 1841. What that means is I'm basically paying $20 a month for $15,000 of furnishings that I bought over over time, right? Seller financing, and for only $5,000. So what did that do for me, right? That would theoretically reduce, or I guess there you go. My cash on cash return is 7.31% in this scenario. Whoops, that's because it's 6.11. Once we get rid of the rehab and renovation costs, because now we're buying the furnishings, my cash on cash return is now 7.42%, right? So we've taken it by increasing cash flow, reducing our entry costs. We're able to, I leveraged first the inspection report to increase cash flow, reduce the seller finance loan interest, right? You got to be really strategic when you're going through this process with your sellers, especially on seller finance loans where a lot of this is negotiable. We were able to eliminate all of our furnishing costs to replace all the furnishings for the seller. And I really drove on the motivation of, is this something you really want to deal with, trying to move furnishings out of a property that tenants are already occupying, whatever. Great furnishings, great remodel. So, it worked out for the both of us, reduced my entry costs. And then I leveraged by ensuring, because I bought so many properties at this point, and I know, and I've talked, my mentors and all that, I was able to further reduce the closing costs by ensuring when we are purchasing the property, we are receiving the prorated rent. So we bought it right around the middle of the month. We're receiving the remainder of the rent for the rest of that month. We are prorating the taxes. So the seller is responsible for paying the portion of taxes for their time of ownership. We're ensuring all that is occurring, taking my approximately, it was $99.50 was the original closing costs, right? So it's 7.57%. I essentially got $41.25 in credits, reducing my final closing cost to $58.25. So I was able to turn this deal from something, around 3% to 8.05% by leveraging the inspection report to increase cash flow, reducing my entry costs by buying the furnishings from them directly, and by asking for some of these credits at closing. And on top of that, for the rents, I was even more confident with this deal because the smaller, remember there's a 3x2 and a 2x2, the smaller unit was the one renting for $2,500. So I knew that at minimum, I'd be able to at least get that when this next tenant moved out. So basically my rents at minimum from $2,350 on average will be $2,500, which then further sealed the deal for me. And I said, okay, I'm getting a 12% cash on cash return, $651 of cash flow a month. Worst case scenario. Best case scenario, I'm getting $1,551 in cash flow a month and almost 30% cash on cash return without reserves. That is a deal. That is, there's no one that would not buy this deal. And because I leverage other people's money to purchase deals, this one was a private money partnership. Our private money partners paid all the entry costs and we split ownership and benefits of the property. So for me, all of my returns are infinite. All of this, the cash flow, principal pay down, interest pay down, which is a tax deduction, right? Not really paying interest down, but you get tax deductions on the interest you're paying. The depreciation benefits, the appreciation over long-term, especially in a multifamily property near Atlanta, near the airport. And my private money partners, they're getting excellent returns too at 8.44% and 33% return on investment. Actually, they had a different ownership split than this, but they're also getting it. And for me, my returns are infinite. The returns for Adam and I for Coast to Coast Vets. So I went over this to show you all the different levers that you can pull, and there's still so many more, but the different levers that you can pull to structure this deal. And no, not all of my private money lenders are equity partners. This instance, we went with an equity partnership because it was such a good deal. We were able to really maximize the returns for both of us and still get us the majority of ownership. But if I decided to use a private money lender, that's what's cool about this calculator. If your entry cost is 64,774, if you get a 10% private money lender, and I didn't want to have to refinance out of this loan in a year. With private money lenders, you have to be able to pay them out on their principal. I didn't want to have to do that. I wanted to keep this 3.5% interest rate loan for the full balloon, and my balloons always include two contingencies. I need to be able to refinance at an interest rate at or below the existing interest rate, which 3.5%, that'll never happen, you know. And then, or I need to have at least 35% equity in the property. So it's an easy refinance for me at that balloon period. If not, it just continues extending 1 year at a time until one of those is met. So if I use a private money lender on this, right, that's gonna, and I'm paying them 10%, that's $540 of interest I'm paying them back every single month for that 64,774 at 10%, you know, divided by 12. So that leaves my net cash flow at $111, but my returns are infinite. So I'm using a private money lender owning the entire property, and my returns are infinite in this scenario because I'm not using any of my own money and I'm not giving up any ownership of the property, right? And this still pencils out in that regards. But in this scenario, I went with a private money partner instead of a private money lender. So that is seller financing and how we're able to take a deal that was, I don't know, 3% up to 12% on the worst case scenario. Any quick questions before we go in over a quick hybrid deal analysis? So Rebecca, yeah, real quickly. So what I put on my balloons, I mean, the seller has to agree to it, right? But I say, hey, you know, I'm buying this property for what I can generate starting today, right? I understand you want to sell it at your terms. I also will only buy it if I'm able to get what I need to as an investor. Otherwise, there's no point in me buying this. We have plenty of other properties we can buy instead. So if this is going to work for both of us, I need to make sure it works for both of us. So what I do is I include in our contract with the seller, even if it comes from a wholesaler, we amend it and we tell them, hey, this is actually the terms that we need for the balloon. And that's what we did in this scenario. We said we need to, at the 7-year balloon, if we do not have an opportunity to refinance at 3.5% interest or lower, or we do not have at least 30% equity in the property, right? Your equity divided by the value of the property. If it's not at least, I think it was 30 or 35%. I don't know. It's one or the other. 30% equity in the property where it'd be easy for me to refinance to a different loan product. The loan continues to extend with the existing terms 1 year at a time. Just if it's 7 years and it doesn't hit, now there's another year. So now it's 8 years. It's another year. So it's not 9 years. And it just keeps continuing until one of those criteria is met. I can refinance at 3.5% interest or lower, not likely to ever happen again. Or I get to, or I'm able to, no, I can refinance it or at least sell it. Because at least if I have 30% equity, assuming the property value never goes up, equals 0.3 times 450. I mean, there's $135,000 of equity in the property that I can realize at that sale. So I know I'm gonna end up in a great scenario either way, because I don't want to tell the sellers, you know, I don't try to hide, you know, my ability to underwrite with my sellers. Tell them, hey, it's got to be a good investment for me now, and it's got to make sense. So if I offer you a balloon, I have to be able to wait to actually exit this deal and not mess it up, right? Like, so either I have to be able to continue having it perform with the terms I underwrote it for, or I need to be able to ensure that when I sell it, I have the money that I need to be able to pay you back. Let's see what's next. I think that's it. I think that's it for seller finance. The cool thing is this $45,000 that we paid to the seller, they netted around $40,000. Just this week, I leveraged the capital we gave this seller to purchase another property with them as our lender for the deal. So the $40,000 they ended up netting, I got all that back plus another $3,500, paying them interest to purchase another property with that. So don't forget, when you're giving your sellers this amount of money, most people don't really know what they're going to do with it. So then you are, yeah, we got them as a seller finance. They're the bank on the seller finance loan. And then we leverage their 43,500 to then be able to purchase another property with the money that we gave them a few months prior. So there's a lot of ways to do that. Ownership percentage, Gus, that is a, I'll talk more about it in the future with more trainings that we offer. But this is high level, right? Really want people to understand how to use this calculator as much as possible. So next is a hybrid finance deal that was posted in sub 2 in Moreno Valley, California. So let's quickly look at that. And I don't say this to disparage anyone or their deals. California, if any market is great for appreciation compared to others, you should definitely make sure you should definitely count for some level of appreciation there. I know I do in San Diego, but from a strictly cash flow perspective is how we're underwriting these deals. Kyle, do you have a quick question? Let me unmute you real fast.
Yeah, man, this is amazing. So when you're going in and underwriting, I'm newer to all of this. So you have all the terms from the seller already communicated before you kind of bring this to, the calculator and things like that.
Not necessarily. Sometimes you're making assumptions, right? At least up front, you have to do a lot of assumptions typically. So being able to understand your markets and understand what are fair expectations for expenses, taxes, insurance, things like that is really important. But for the terms, right, it's a back and forth with you and the seller. At the end of the day, if you guys are committed to getting the deal done, usually one or two things of all the levers are the most important for the seller, between purchase price, down payment. Maybe they need $20,000 to go pay for a boat or an RV, or they are really adamant, I've always wanted to sell this property for $450,000, regardless of the monthly payments or the money down, or they need certain monthly payments. They have a sick in-law who needs $1,000 a month to cover their expenses. Like, you have to understand what is the important lever or two for them. Usually it's one or two things, and you have to be smart about the way you strategize around the remainder of them. Because at the end of the day, I tell every seller, I get it. You want to sell this property. I actually want to buy your property for sure, but I will never buy a property that's not a good investment because there's other properties to buy. So, you can tell me all the terms you want. I will underwrite it and I'll see if it makes sense. If not, then I will tell you what terms might make more sense for me. And if we agree, awesome. We have a transaction, right? Buyer, seller, agree. If not, oh, well, we'll move on to the next one. Like, that's fine. So you have to also understand, have a very abundant mindset when it comes to real estate investing. Like, don't just buy properties for the sake of buying properties, because you've seen in a multitude of real estate investing communities, including my major one that I'm part of and try to add a lot of value to, people buy deals that suck, terrible deals up front. They use other people's money to do so. And then everything ends up collapsing on them. So you have to, the whole point of underwriting effectively and trying to build a portfolio is understanding the terms that you are buying the property makes sense for your financial goals. If you're buying properties for the sake of buying that, then you're screwing yourself, right? And that's the same thing for when wholesalers sell deals to someone. You can't control what a wholesaler does. They're like an agent. They're like anyone. They're just saying, here's this deal. Does it make sense for you or not? It's your job as the buyer. Or, if I was too on, I don't want to say anything disparaging to wholesalers because I am a wholesaler as well, but I would always think of my end buyer first. My assignment fee would be dictated. So let's say my assignment fee, I'm trying to get them, let's say, an 8% cash on cash return. My assignment fee would be, let's say, $15,000 in this scenario. No, so it'd be 25,000. I don't know, whatever. And that gets them 9.79% return. My assignment fee is dictated on the returns for my end buyer, right? If this deal only made $200 a month in cash flow, 3% cash return, my assignment fee would go down, let's say, to $5,000. Well, this scenario isn't great, but I would use the cash flow to determine what my assignment fee is, because a lot of these are fixed, right? Some of the things you can negotiate with the seller. Some of the times, like, I negotiate the agent commission with the agent, and I say, hey, someone's got to give us some money. And, you really weren't able to perform on this conventionally. Let's see if I can get this deal done for you. But we need to take a little bit off the top for you. Maybe we need to take a little bit off from the seller, maybe the wholesaler, whatever, because the cost to renovate the property the cost to pay back any liens, the cost to cover the closing costs, admin costs, your reserves, all that you can't really change. There's only a few things you can change as part of the entry. So you have to understand that deep enough to understand what the what makes sense for you. And thoughts on assignment fee, $1,000 per $100 of cash flow. That's just like the 1% rule when it comes to real estate investing conventionally. The 50% expense ratio rule. These are all just like quick rules of thumb, but they don't actually work. Like it's a good way to maybe quickly filter something, but that's not, you know, that's not how most deals are being sold. People are selling deals that have literally no cash flow for $10,000 assignment fee, things like that. It's just a good rule of thumb, but rule of thumbs don't do you a lot until they're a quick filter. You need to be able to underwrite these deals thoroughly to actually understand what your returns are as the buyer. Cool. So
Awesome. Thanks, man.
yeah, no worries. I will move on. All right, we have one more here. Whoops, we're going to do the hybrid, and I will stay longer and underwrite your guys' deals and answer questions for you at the end as well. So thank you so much for staying on. So there's a hybrid finance deal in Moreno Valley, California. So Moreno, California. This one is actually a fairly thorough. This is actually a very thorough. So I appreciate, this is not a deal for my buy box, and you'll see why, but I appreciate the very thorough breakdown of the terms of the deal. So it's easier to underwrite. And when people say, oh, you have all the info you need, don't ask me to DM you more details. It's like, well, you really don't have all the info you need usually. So this is a 5-bed, 4-bath, 3075 square foot property. The purchase price is $650,000. The down payment is $40,000. And we can just click, you know, equal the 40,000, the backslash to divide 650. So that's good. 6% down payment. That's awesome. The loan that you're taking over subject to, right? There's subject to loan, there's the down payment subject to loan, and the seller finance loan that equates to $650,000. So the original loan terms, so this is a refinance, right? They refinanced it. Actually, I was able to pull that from PropStream. 229,500. Not everything is accurate in PropStream, but certain parts are. Typically, you want the interest rate in the PITI from the wholesaler or the seller at minimum before you can see a mortgage statement. But usually the loan amounts are accurate depending on the state that you're operating in and the loan start date. So it's 2.625% interest, 30-year loan term, and their first payment was 1/1/2021. So that means the loan will be fully paid off 1/1/2051, right? That's the 30-year amortization. That's what that means. This one does have a balloon, and it's going to be both for the seller finance loan and for the sub-2 loan. But before we can get to that, let's see the sub-2 loan that you're taking over. They said was $214,000. We can verify again, what should the loan roughly be at this point? So you look at your sub-2 payment schedule. Yeah, it's around $214,000. They're right. Like it's a good way to look at your amortization schedule and determine what the value should be at roughly. Okay, Zach had a good question. Why would someone put a balloon on the sub-2 loan? Well, not everyone wants to leave a loan in place for 30 years under their name, right? It's not my choice. If it's my choice, I tell everyone I'm buying your property at this price because I want to keep that 2.625% for the full duration of the loan. But not everyone is open to that, especially when it comes to VA loans, because you can reuse a VA loan more than once and you have entitlement, and I have a great video on YouTube for that. Please check it out. Check out my YouTube channel. But now they might want to reuse their full amount of VA loan, or they have any reason. It's up to the seller. Typically for this scenario is they want full access to their VA loan, or they want to be able to purchase another property. Like it could be a debt to income issue they're concerned about. Some of that is negotiating, right? Some negotiation and educating the seller that, hey, we can actually alleviate this debt to income ratio for you to be able to buy again. Maybe you don't have the VA loan or the full amount, but you can use an FHA loan, 5% down conventional. So it's really good to be knowledgeable about all that kind of stuff. There's a variety of reasons. But for this VA loan in particular, that is my expectation I have. This is just the deal that was brought by a wholesaler. So, you know, I don't know what I haven't talked to the seller. I like to always talk to the seller if I can. And the seller finance loan in this scenario is, something's a little off here, but that's okay. $396,000. So we're like 7K off. I don't know. I don't exactly know why that's the case. Let's just increase this to $47,000. And that'll put it back to this. They said the interest rate is 5%, amortized over 30 years, and there's a balloon on both the seller finance loan and the sub 2 loan. So every month you're paying principal and interest on the sub 2 loan, $921.79. You're paying $2,088.24 to the seller and their seller finance loan, and you have a balloon 7 years for both of these. So in 7 years, your seller finance loan balloon will be $341,000, and for the sub 2 loan, it'll be $170,000. So the combination of these two is $511,000. So either you'll have to refinance that property in 7 years and see if it still makes sense for you, or sell it and make the spread between the loan amounts that you have to pay out and the purchase price of the property. Wait a minute. Yeah, that makes sense. Okay, so the rental income on this property using Rentometer, this is already not a deal, and I could quickly tell you that. But just the principal and interest and seller finance loan already exceed the total rent, right? Could you get more strategic? And this was quick. I just pulled up the quickest, Rentometer estimate for it. Didn't really care. Just wanted to show you an example. But could you pay these funds, or could you buy this property and still make it make sense for you? Potentially. It's ultimately up to you, what your investing goals are, especially in California. But so the taxes due on this one between tax and insurance is $870.63. So we're going to just say, we're going to quickly estimate this. So we're going to say the taxes, insurance is, let's say $1,800, so $150 a month. And then these two should equal $400. So what I like to do is I put equal we know the principal, interest, tax, insurance is $1,792.42 minus your sub 2 principal and interest minus your insurance. That means your taxes are approximately $721 a month. You click equal the 721 times the little star times 12. You're paying $8,648 in taxes, which translates to $721 a month in taxes and $150 a month in insurance. Single family home, you're not going to be worried about paying all this stuff, but there is solar in place. If you're covering the solar for the seller, for your renter, that's $136.35 that you're covering for them. Or you have them pay it and you include in the rent, whatever. And the HOA is $30 a month. Once you have your property management, vacancy, maintenance, and capital expenditures, and then let's actually do the entry cost. So this is your income and expenses. Obviously, it's super negative cash flow. Maybe you try something more creative, like a mid-term rental, short-term rental, up to you. Or someone wants to live in it, can make sense for them, but from an investment as a long-term rental, it's already going to be super negative cash flow. Not even worth investing any money to buy it in that scenario. But the down payment to the seller is pulled from above. There's a $7,000 agent commission. There is a $20,000 assignment. Oh, whoops. I'm out here messing up things. $20,000 assignment fee. Let's say 1 month of carrying costs. Nice property in California will rent out really quickly. My properties in Fairbanks take a month, sometimes 2. My properties in Atlanta, a few weeks. My properties in San Diego are rented before they're even the tenant moves out. So it really depends on your location. Say it's a 2% closing cost. There's 0 rehab. It's fully turnkey. $500 or $1,000 for your inspection and LLC formation. So in total, you're putting $112,000 to buy a $650,000 house. It's still 17.24%. So it's still lower than we get at a bank if you had to buy an investment property, but you're losing $2,000 a month in cash flow. Worst case scenario, losing $1,482, best case scenario. So a lot of deals that are hybrid don't make a lot of sense. Because between the existing loan in place and between the seller finance payment, you're more than likely already negative every single month, just between those two alone. But that's why it's really important to underwrite these things. You could have quickly determined that by just looking at the rental income minus the loan payments, but you had to be able to account for that. If you're looking for different reasons to buy the deal, maybe you can do, you could do that. But I'm going to do a few live demos for you all. Stay extra to do that. But real quickly, I just want to highlight a few things. I hope you all at least took 1 or 2 nuggets away from today, and it helps you be a better real estate buyer, wholesaler, lender. It helps you either purchase your first property or your next property much more informed. I appreciate you all being here on the Saturday. I mean, what an amazing concept. There's still 88 people here on the 23rd of December. We're, the day before Christmas Eve on a Saturday morning or Saturday afternoon, depending on where you're at. But, Christmas is around the corner. You could be doing anything else. So I appreciate you investing your time and effort into trying to become a better investor. So I appreciate you being here, especially the 87 or whatever that are still here. So I appreciate you all. So there's a few things I want to highlight before we end and we go into the live underwriting and Q&A. So my creative real estate investment calculator, if you haven't received the free calculator yet, you should have access to it from the Zoom link. If you haven't, it's on my Instagram, it's on Esteban's Instagram. Make sure you're getting the free calculator. But this pro version, which accounts for a few more things, we have our private money partner breakdown here. We have, if you decide to raise debt on this, and it's a whole nother concept, and it has different exit strategies. It accounts for more of that, and you get lifetime access to every single update we make on this calendar. And I'm not one to hide pricing or whatever. I know people say, oh, DM me. No, we sell this one for $400 starting right now until the end of Christmas. We're doing a 50% discount. Last time we discount this, everyone who's already bought the calculator before gets lifetime upgrades to the newest version of this calculator. So everyone who's already bought, don't worry, you get upgraded to this pro version from your previous pro version. And I'll come with a lot of underwriting trainings like this one, and ideally some private underwriting Zooms as well. Esteban is going to talk more about additional features outside of just the underwriting. So I'm going to unmute him so you can do so.
All right. Can you guys hear me? Michael?
Yeah, we're good.
Cool. So I just wanted to talk about the calculator real quick. Do you want to go over to the history tab, Michael?
So yes.
So whenever you underwrite a property, once you send out an email, it basically logs the address on the same Google Sheet, and it creates a link to the calculator, and it lets you know if it was sent or not, the email, and then the name of the person you send it to. You can't see it on the screen, but there's actually a search function. So let's say you've underwritten maybe like 100 properties, and you're trying to go back and maybe visit a previous address. You can just pull up the search bar, as well as what this calculator does. It whenever you underwrite and you send an email, it actually sends a copy of the calculator, and it'll title it the address of the property. And so whoever you send it to, they can just open up the calculator and maybe, mess with the numbers a little bit. It's got a lot of updates. This is our version 1 of the Pro calculator, but just a quick glimpse of what's to come. They'll have access to PropStream, Rentometer, Zillow, and all that. So in the near future, when you populate an address, it's automatically going to pull comps, give you the Zestimate value, Rentometer, and a couple other things. So that's really just what I wanted to mention, Michael.
Awesome. Yeah. So there's a lot of awesome integrations, and the big one is going to be, you're going to be able to really quickly and easily send these deals from the calculator. You're going to be able to send an email, the actual copy of the calculator, right? Like a PDF version that you can send out to your lenders. Whether if you're a wholesaler, you can really showcase a lot of this underwriting to someone directly, or what you want to. If you're a buyer, you can send this to your lenders and partners quickly to make decisions together. As Esteban mentioned, there's a little dashboard here, and that's not on these ones. I've closed out of them at this point, but there's a lot more info, underwriting trainings, and all that included in there. Esteban, can you please drop the link to purchase the calculator and the discount code?
Yeah, I'll drop the link, and then also anyone who gets the paid version, I'll also send you a tutorial how to get everything set up, as well as some, couple little, tricks on there. as well. And we do have a free version. Of those of you who don't want to purchase the Pro Calculator just yet, there's a free version and it has a lot of the similar features, including the email feature. So let's say that you need to send the address or numbers to your partner, a wholesaler, or whatever. You know what I mean? You just click send and it basically takes everything from that Google Sheet and it just compiles in a nice looking email, with all the details. So let me go ahead and get that link.
And the discount code, please. I really want to make sure people get the discount code, especially those that have been on here or watch the replay within a timely fashion. I will say that the discount code is CAL Pro 50. And everyone, just to confirm again, everyone who bought the previous version of the calculator, not the free calculator, right? You still have access to the free calculator, but everyone who bought the paid version of the calculator previously will get this upgraded version as well. So don't worry, I'm going to make sure that you get upgraded by the same time everyone else gets the calculator. So I wanted to highlight that real quickly. If you are someone who is just starting out real estate investing, we also have a few other things. Like I said, my number one goal is to help people achieve their to achieve financial independence for whatever reason that they're looking for primarily. Everyone's got their own reasons, their own why, but that's a passion of mine. And so starting January 2024, people have been asking me for a long time, for years now, about starting some types of trainings. And when I leveraged my first mentorship, I remember asking him, why should I give you $10,000 when I can just invest that into real estate myself? And he said, well, with the stuff you're going to learn from me, I will save you way more than $10,000. So what is your return on investment for that, right? It's not money you're just spending. It's an investment you are making to either be able to save money or make a better purchase in the future. And it's your ability to be able to build off that skill set and continue improving from there. So we have a 12-part buy and hold real estate investor bootcamp. It'll be live. Like I said, I don't hide pricing. It's $2,000. This will be the only one I probably do live moving forward without increasing the pricing. After that, it'll be recordings. But this one's going to be a live 12-part series we're going to be doing together. This is ideal for those that are beginner and intermediate investors who are looking to find and confidently analyze residential rental properties. This is people who are maybe a wholesaler who wants to now buy, someone who's been looking to buy, has the capital to deploy and wants to, maybe someone who's a lender who wants to understand, how do I better understand what is a deal versus not, or someone who wants to be able to leverage other people's capital to buy deals. This is going to show you a lot of that. We're going to break down the entire process from you defining your buy box, your market that you're going to be investing in, how to build your team in that market, whether it's out of state or in state, how to find deals in that market, and then how to confidently analyze them. You're going to need a breakdown of all of my deals that I've ever purchased, all 42 rentals. You're going to get 6 months of accountability check-ins and 2 months or 2 times a month live underwriting Q&A sessions in addition to these trainings. And then you're going to get lifetime access to all of the training recordings. You get access to all of my real estate investing documents, templates, and underwriting calculators. So if this is something that you want to do, you get the pro version of this calculator included in here. So if this is something you want to do, we will send an email follow-up with a link for you to sign up to join the waitlist. We will be starting early January 2024. I'm going to do it after work hours, Pacific Standard Time, so everyone has the ability to join. So I just wanted to highlight that if you're a beginner or intermediate investor looking to really get into buy and hold real estate investing or better understand buy and hold investors, there's that. And then I have a 6-part advanced underwriting bootcamp that will be coming out. Once again, if you've already purchased the calculator, that money will directly be reduced from this amount.
Real quick, I keep seeing messages about the discount code. It is being fixed. I did see somebody purchased it at the full price. We'll make sure we give you the refund for 50%.
Yes, please.
Yeah, just give us a second. We'll get that fixed. So I noticed somebody asked here, what's the difference between the free and the paid? Do you want to talk about the free version, Michael? Just briefly, and I'll explain the paid, what it includes.
Yeah, so the free version is similar to this conceptually. It's a little more simplified, and there's only long-term rental deal analysis on there. You don't have the private money partner breakdown. So if you're someone like me who likes to leverage private money partners, to buy more deals than you could with just private money lenders. You don't have that type of breakdown. There's a little bit more rental estimations, and you get lifetime access to all of the improvements that we make. So people continue to ask me for certain things, and I continue making improvements for them. So you get lifetime access to all those improvements. And you get more trainings and all that are included, and you'd be included in our underwriting Q&As, that like the restricted underwriting Q&As. And then Esteban, you can talk about some of the additional features outside of just underwriting.
Yeah, so some of the integrations that I'm working on is, like I said, you'll be able to just type an address, and then just by typing the address, it's going to give you the comps on Zillow, the Zestimate, Rentometer as well. It gives you an analysis. We already have that feature. It's just not out yet. We're still doing some beta testing. As well with this calculator, whenever you hit send the email, it compiles everything in a nice looking email, gives you the cash on cash return, entry costs, everything there is to, you know, to the deal. And then, like I said, it actually makes a copy of the calculator, and it sends it to whatever recipient you're sending it to, so they can open the calculator up and they can play with the numbers and see, you know, where they need to be at. As well as there's some other integrations. There'll be a LOI generator and a contract write-up feature in the very near future, where ultimately you'll be able to generate LOIs, contracts, just from this calculator alone, as well as all the underwriting Zooms that Michael's going to be having. And then we're working on some kind of Kajabi course where those who purchase that calculator, you'll have all kinds of videos of underwriting from, you know, multifamily, single family, pad split. And then me, myself, I do more assisted living and hospice. So Michael and I are going to be working on a calculator for that in the future. So anyone who gets the paid version, you get unlimited support and then all future updates. And then if you guys have any issues or whatever with the calculator, I'll get it fixed right away. And if you guys want any custom integrations as well, it is a plug and play with Go High Level. So if you're using like REI Reply, Open Dispo, Unapologetical Results, and a lot of CRMs, you can directly plug it into the CRM.
Okay, cool. Thank you very much for that. And then 2 questions. Yes, short-term rental analysis, pretty straightforward here, right? It's what your furnishing costs will be, what your short-term rental income would be, the additional expenses that you'd have to account for with the higher property management and utilities you'd cover, and then the cash flow and cash return as a short-term rental. And then the reason why you'd want to email. So I have partners that I buy deals with, whether it's lenders or my business partner. So it's really important to be able to quickly send, you know, we're not underwriting 1 deal a week. We're underwriting multiple deals every single day. So it's an easy way to communicate effectively and quickly and seamlessly the terms of the deal that you're looking to buy. Because time is money when it comes to buying these deals, especially if it's not your deal and you're buying it from someone else, a wholesaler, or an agent brings you a referral. You want to be able to execute quickly. That's a competitive advantage. So the next quick thing I want to highlight is, so the 6-part advanced underwriting bootcamp. So if you're a beginner, intermediate, or advanced, this one is very specifically focused on a lot of the things you guys asked questions about today. Everything you need to know about underwriting deals, how to effectively comp ARV after repair value, how to effectively comp rental income, get a better idea of insurance and taxes and all that kind of stuff. What levers you can pull, like that deal that I showed you, and the duplex in Atlanta, what levers you can pull to create the most optimal deal for you and your buy box. This is great for buy and hold investors, lenders, and wholesalers. We're going to focus on the different benefits of buying and holding real estate. So it's 6 parts: underwriting, the different acquisition strategies, comping, ARV, rental income, taxes, insurance. You're going to get multiple full deal underwriting trainings and live underwriting your deals as well, and incorporating if you leverage a private money lender, private money partnerships, Q&A on comping and underwriting and creative finance. So I'll just answer everything I can for you. You see, once again, you see the breakdowns of all of my deals that I've purchased, 6 months of accountability check-ins and 2 months of 2 times a month of live underwriting Q&A sessions, lifetime access to the training recordings, and access to all of my real estate investing documents. So once again, if you purchase any of these trainings, these boot camps, you will get discounted the amount that you paid for the calculator, right? Since that will be coming out later for this. But I just want to highlight that this is something in the works. And you know me, I'm extremely, everyone that does know me, I'm extremely thorough. So I want to make sure I provide a ton of value before we just push it out there willy-nilly. So Q&A, analyze, I can answer any of your questions in regards to underwriting, in regards to creative finance. If you have any, we can focus on analyzing your properties. If you have one, I can maybe do one deal right now, a creative deal. If you have all the info, I cannot pull up addresses and all that in this format, since this will be shared publicly. I don't want the video pulled. So if you guys have Q&A, please raise your hand. Otherwise, happy holidays, and we'll just all roll out. So, all right, Edward.
Hey, how's it going? Appreciate you guys for all this information. I don't have a deal done, right? I'm right now working on getting my first deal, but I've been hitting up all the agents that I know, friends and stuff like that. But I'm primarily doing door knocking. And one of my friends, she's an agent, somewhat new, but she kind of gets an understanding of creative, so she's like really excited about trying to know more about it. And her brother-in-law she was selling a house in Simi Valley, and she was asking about, like, because he had an adjustable rate mortgage on the house, and he has about 50% equity. If he can do like seller, well, she just says seller finance. I said, well, that could probably work as a hybrid deal. But with that, I was talking to another sub-2 member, and they were saying, well, why don't they'll probably need to refinance it. Now, would it be best to like recommend like refinancing it like over a longer period, so that way there will be more of a ability to get to cash flow on it?
Yeah, so that's why a lot of deals, like if you're a real estate investor, if you're living in a primary residence, leveraging a 15-year term is great. Because you're paying off your home sooner. But if you are a real estate investor, you really want to expand how long you are making those payments, because of all the benefits that are associated with it, plus you're maximizing your cash flow, right? It's really ideal, because most deals are already hard enough to make sense at a 30-year amortization. It's even harder at 15 years. But it really depends on their ultimate goal. If it's maximizing cash flow, you're going to do that. You're going to pay more interest over that time period, but you're going to make more money each month. In regards to the adjustable rate mortgage, it depends. Did it already adjust and it's basically at this for the next 5 years? Is it, because we're kind of near the top of interest rates for the most part. I'm not, a psychic. We're roughly at everything the economists have said, we're roughly at the top of interest rates. So if it still makes sense at these existing interest rates, there's no real need to refinance it, because interest rates will probably go down from here moving forward, or at least stay flat. But if it's still at 3% and it's yet to adjust, you're going to need to underwrite. Does that still make sense once it does adjust to 7.5% or whatever? Will that make sense in that regards? So it really depends on, has it already adjusted or not? And does it make sense at its current terms versus future terms? I've never purchased a property. Well, I've purchased multifamily properties on commercial loans that are adjustable rate mortgages, because that's the product that they offer for commercial multifamily 5+ units. But I have not purchased a property subject to an adjustable rate mortgage, because typically you're buying it before it adjusts. So you're going to be screwed once it adjusts in 12 months, whatever, and you're going to be forced to refinance or sell. And, it may not make sense at that point. So you have to underwrite it as is and what it will adjust to. Hopefully that helps.
That's amazing. Thank you so much. Appreciate you guys. I got to go
actually
take care of my son, but
okay, you're good. And what I'll say on seller financing deals, I definitely love to increase my amortization to 30, 40, 50 years, especially if they want a balloon. I say, all right, fine. I'm going to make even more money over time. I'm going to make more money over the next X years. Yeah, I'll pay more interest over the long term, but I'll be making more money over time, and because I'll be paying, right? So instead of 30 years, it's 50 years. So, well, this is a terrible example, and that's why I focused on payments. So, and this is the stuff we'll be talking about in my underwriting, like advanced underwriting trainings, but like, how can you make the deal make even more sense for you, right? How can you negotiate and structure a deal that is a way better return for you, as opposed to just taking it at face value, especially if you're focused on conversing with the seller, focused on monthly payments as opposed to interest rates, right? So it's 1841. Let's say it's now principal only. You just adjust it to, let's say, whoops, it'd actually be less years. So like you're still getting them the same payment, but now you're paying principal only. That is a huge benefit because now every single month you're paying off that debt directly. Oh, Nina has a deal. So we can probably underwrite that after. We'll do these next 2 questions and then we'll underwrite for Nina. Cody, let me unmute you.
Hey, Michael.
Hey.
Just had a quick question. We actually have a wholesale deal that we're trying to start up today. We got in contact with the seller and he's willing to take our offer. We just had a couple of questions about the purchase agreement, if we could ask those real quick.
Sure. It's not the focus of this one, but I'm happy to try to answer what I can. And I will say the number one thing you're gonna learn, or not saying anything, but the number one valuable, most skill set you can develop is finding the right people to do these types of things for you. For example, I leverage my transaction coordinators, my title company connections as much as possible because they're the ones who look at contracts all day, every day, not me. But I'm happy to try to answer your question. So I just wanted to preface it with that.
Hey, thanks. I appreciate that. That's actually one of the questions that we had. So the title company, we don't have a title company yet, and they're all closed today. So
Yeah.
we were we were just kind of curious at can we send this contract over without having the title company on there, or does that need to be done first?
No, it does not. You don't
Okay.
need to determine your title company up front.
And the second thing is on our contract here, it says that we need a total purchase price, which we know, a first and a second deposit, and then a balance at closing. Is there any way to determine what we need to put for the first and the second deposit?
I don't even know what your first and second deposits are. Usually you have an earnest money deposit, right? Maybe in the second deposit they're talking about is a down payment, but I can refer, like if you have a really good transaction coordinator who's used to doing this, they will tell you the title company you should use. You shouldn't, it's not the highest and best. If you're out here structuring deals with sellers and trying to buy them or wholesale them, it's not the highest and best use of your time to find the perfect title company. It's you find a great transaction coordinator. I can refer you if you message me to TCs that I use. And they should be the ones to tell you what title company you should use for the transaction you're trying to perform on. But I can't answer your question. There's not enough information. Usually the first deposit is going to be an earnest money deposit that basically it's sent to title to like solidify or validate your purchase agreement, purchase and sale agreement.
So for just the purchase agreement itself between the seller and us, the wholesaler, we don't need any money down?
You'll need some type of earnest money deposit. I bought properties with $1 down. I bought properties with $20,000 down. It really depends on the seller. Typically, I'm buying it for a lot less.
Okay, so essentially we could just leave the first and second deposit on here blank.
I would put an earnest money deposit for sure. An
Okay.
EMD.
And what would that look like?
Whatever the seller's comfortable with. Like I said, I've bought them with earnest money deposits for a $2 million property at $1 earnest money. It's probably pretty messed up. I should have at least put something more normal, but usually we do 1% of the purchase price as the EMD or like $1,000, something, I don't want to over put money into as EMD, but it really is what you and the seller agree on makes sense for you guys to move forward with. If that makes
Okay,
sense.
and the last question I have is the legal description. Is that something that the escrow company is going to, or I'm sorry, the title company is going to outline?
Yeah, but what you need, Cody, is a transaction coordinator who's done this before. They will handle all this for you. They're well worth I don't know, $1,500 or whatever. I don't know, whatever we're paying now for them. They do it and the title company will further define it. But at minimum, you want the address or APN, I don't know, assessed property number. I don't even know what APN stands for, but you want that written down there so you guys are agreeing on the same property.
It sounds like having a transactional coordinator is really, really helpful, but just for the purposes of our first deal, we don't have that upfront cost of $1,500. Is there any way
No,
for us
you pay them at closing.
I'm sorry?
You pay TCs at closing. Sometimes you pay a deposit up front. I don't necessarily anymore because I'm a trusted buyer, so I pay them at closing. Sometimes you'll pay a 50% deposit up front.
Okay.
And if you're wholesaling, your buyer is going to cover the cost of that,
Okay.
right? So hopefully that helps.
Yeah, I'm just trying to get this contract sent over to him as fast as possible so somebody doesn't else.
Yeah, so
doesn't
at least
sneak
put
in.
the address down. I mean, John Motz, I would say the best thing you can do if this is your first deal is to JV with someone who's already done this before. If you can't afford, this is why people use Gator lenders to fund their earnest money deposits, and they typically pay them a premium because they don't have the money to put the EMD down or to cover some of these due diligence or escrow costs. So this is why people leverage other people's money and usually pay a high premium for it, because they'll make more at the end, but you may not have the capital up front to do it. You can do that if you want to go that route, get a Gator lender to help you fund some of this. I would highly recommend you joint venture with someone on your first deal, because you're going to learn way more than it's going to cost you to split that with them. So even if you pay them 50%, whatever your agreement is with them, you're going to learn way more than that cost is ever worth. And it usually takes 1 to 2 deals to really unlock the floodgates. Cool, Cody. I'm gonna let you go so we can, assessor's parcel number. Thanks, Kim. All right, Nina, where you at? Can you raise your hand? You still have a deal if you want me to underwrite? And there's a lot of good stuff in the meeting chat too, so. Nina, like 5 more seconds. I don't see a hand raised. She might be out of here. If you're having any issues with the calculator, I'm sorry. Esteban and the crew will make sure everything works. I heard some people are not getting the calculator automatically. If you pay for it, you are getting the calculator. If it takes you an extra 10 minutes, 30 minutes, you are getting the calculator, you're getting lifetime updates to it. You're getting all these things. Sorry if there's a slight delay, but you will get everything. At minimum, we could just send you. Yeah. Oh, there's Nina. Awesome. So all the technical difficulties will be resolved, but I highly agree. C3 is the title company, or the a TC company that I would also recommend. They are phenomenal. I've used a variety of TCs. The C3 is a great one. So that's in the comments. All right, Nina, let's underwrite your deal and then we will call it a happy holidays. Can you hear me? Or can you speak? And I love seeing all the sub 2 people in here too, which kind of makes sense, right? We're talking creative finance. Nina, I can't hear you. Nor see you. Thanks, Tech. Thanks for being here, man. Appreciate it. All right, Nina, we're going to say, all right, I'm going to ask to unmute again. And if not, I will say happy holidays. Remember, we have the trainings coming out. If you pay for the calculator, you get some of these live underwriting already. We can go over more deals that I've done and deals that people send over, just underwriting. You're going to learn that the majority of deals you underwrite, right? 95% of properties for sale are not deals. Doesn't matter if it's a wholesaler, agent, on market, off market, whatever, the majority will not be a deal for you. So your job is to quickly and effectively filter through that. And that's what I'm hoping to teach you all. I show you exactly how to do, whether you're a buy and hold investor, lender, wholesaler, whatever. So you don't waste your time. You're wondering why your deals are not displaying, because they're not deals, they're just properties under contract, right? All right, Nina, I think we're going to have to call it. We can do that later. I also offer consulting for underwriting, but that's a whole different thing. This course should be a much better version of that because I can spend a lot more time with you all. So cool, everyone. Well, happy holidays. Merry Christmas if you celebrate. If not, happy holidays, happy new year. And I appreciate you being here, when you could have been doing anything else. So thank you so much. If you purchase the calculator or intend to, the team will make sure you get your copy, and we will share all of the information that we can about the upcoming courses, whether you're looking to buy, the 12-week boot camp, really the real estate buy and hold investor boot camp. If you're looking to buy your first or next deal and be more confident with your underwriting, or if you're looking for the 6-part advanced underwriting boot camp, which we're really going to go through a lot of detailed stuff. So we'll make sure this recording gets sent out to you all. So thank you so much. Happy holidays and bye, everyone.